What do you mean by equity stripping? What is that?
That's kind of a fancy word. Okay, let's talk about that just a second. Remember when I talked earlier about that you went into business to make your own decisions and to have a great lifestyle?
Right.
Well, part of that is as I see small business owners as they become increasingly successful, their lifestyle tends to climb with that. And I suspect that these last few years, the difficulties that have been in the marketplace, hopefully have taught a lot of business owners some lessons.
Oh yeah.
And part of that is equity stripping is kind of a CPA term in that you're just taking every piece of earnings out of the business to support your family's lifestyle. And then the secondary part is to manage for taxes.
Right.
And when you do that, you cannot reasonably expect a buyer to come in and look at your business and pay you what is not there. It really doesn't matter if you've taken it out in the form of salary or you've taken it out in distributions. That is certainly something that we can add back into the equation.
Right.
But if you manage your business for your taxes, there's other places other than salaries that you're taking the money out. You're
Right.
taking it out in the form of vehicles. You're taking it out of I'm not doing your tax returns, so we don't have to visit about that, but your vehicles, maybe your country club expenses, and
Right.
who knows else that...
Well, and there's a lot of personal type expenses, like people
Exactly.
paying their children, that although that's a very good strategy for tax purposes, for trying to sell your business down the road, the potential buyer doesn't know that money went to your children. The potential buyer just knows that money went out of the business. It's gone to any other employee, and they don't know the intimate details of your business. So that's what you're trying to describe.
Exactly, and it would be, as time goes on, it becomes increasingly difficult to go back into a prior period to try to bring that information up because it gets buried within the accounting records.
Absolutely.
So you're really cutting yourself short,
Okay.
I guess is what I'm trying to say that. Now, that might not matter to somebody that is 40 years old and is, got a family and young children. But if you're 50 years old or up, and it's not necessarily an age thing, you may have just started your business and you wanted to groom it and be able to sell it at a certain point. It applies to that too. But you do have to give up a little bit in paying some taxes on it in order to establish a record of a repeatable pattern of cash flow that a buyer can see. And I say 3 to 5 years. You need to have a 3 to 5 year record of repeatable cash flow that's predictable.
So really what that's telling me then is that if I want to sell my business in 5 years from now, I need to basically back off maybe on some of my tax strategies.
Absolutely.
Or find other ways to get that back than lowering my profit in the company. Okay.
That's exactly right.
Okay. So really then, again, just to kind of repeat in a different way, here, if I want to sell my business, I need to start planning 5 years in advance.
Absolutely. You need as much time as possible. Most of the people I work with are anywhere from 3 to 7 years out. And it's the best way. It's just like anything. If you're going to take a road trip somewhere, you wouldn't take it without some sort of a. Now we've got GPS. But you wouldn't take that trip without some sort of a map to get there.
Right.
If you want to turn this valuable asset of yours, your business that you've put your capital into, your sweat equity, all of that in there, then you have to have a visible means to be able to show this to a qualified buyer that this is a repeatable amount of cash flow that can be continued.